that is another aspect of it about this method. And people ask me about it all the time. What do you mean when you tell us to love these people who are beating on us and bombing our houses and kicking our children around? What in the world do you mean when you say love such people? And I always have to stop and try to define the meaning of love in this area. And interestingly enough, Greek philosophy comes to our aid at this point. There are three words in the Greek language for love. One of them is the word eros. Now, eros is a sort of aesthetic love. The philosopher Plato talks about it a great deal in his dialogues, the yearning of the soul for the realm of the divine. It has come to us to mean a sort of romantic love, and so we all know about eros. We've experienced it. We've read about it in the beauties of literature. In a sense, Edgar Allan Poe was talking about eros when he talked about his beautiful Annabel Lee with a love surrounded by the halo of eternity. In a sense, Shakespeare was talking about eros when he said, love is not love, which alters whence alteration finds a bend with the...
Good evening, everyone. Welcome to the 5th episode of the Ask the Wiz Tier 1 Ask the Wiz Wealth Institute class/session. As you saw in your email that went out for the instructions, I just want to go over those one more time. If you have a question, please raise your hand, and you'll see the little icon in your toolbar off to the right of the screen, and I will either unmute you or ask you to chat that message to me, whatever your question may be. And we'll just go from there. So I'll turn the floor over to Dr. Reeves, and if you have any questions, again, be sure to send a chat or raise your hand. Thank you so much.
Top of the evening to everyone out there. Thank you so much for joining us for this, the 5th episode of the Training Beginning an Investor Seminar and Webinar. What we'd like for you to do is, if at all possible, pull your old notes for those of you that have been with us in the past, because I will be cross-referencing some information from in the past that we have indeed discussed. Concurrently, I'd like to also share with all of you some updated information as it relates to what happened today in the market, just like we discussed yesterday on the radio program. Hopefully, most of you heard the radio program either on demand or you heard it live when I was discussing there was indeed going to be an exaggerated Friday fade as a result of Monday being a holiday, more specifically Martin Luther King's holiday. And peace and blessings be upon him, as today is his actual birthday. And so what we did see this afternoon was an almost 100+% point drop, 100% point drop, in the Dow. And it happened just like we had expected. Now, for those of you that are members of the Wealth Institute, and I know we do have some elders on the line listening during this webinar, you should have been able to position yourselves accordingly. And it's not just all or nothing play on UUP when the Dow goes down over 100 points. There are other strategic plays that you should have been making, and I'm going to go over some of those a little bit later on during today's webinar. But first of all, I'd like to go ahead and put out some foundation information. And so what we'll do is we'll go ahead and get started. So for those of you that have your computers also on, we're going to go ahead right now, and we're going to go to yahoofinance.com, and we always go there because it's very, very cheap. A lot of you out there have some more elaborate type of software packages that you like to utilize, et cetera, et cetera. But what we try to do is just break this down to the most elementary level and try to utilize concepts that anybody can use just right off the street to immediately start generating wealth for their family. So first of all, let's go to yahoofinance.com. As you see, I am going there right now. And let's take a look at a couple of things that occurred today. And we're going to set benchmark now. Now, cross-reference this information with the previous webinar, the 4th episode, and you'll see how all of this stuff starts to come together, and you'll see just how easy it is for you to not only obtain but maintain your economic liberation. Now, let's first take a look at over to the left-hand side here, if you would. Let's look at the Dow right here. And once again, just to cross-reference information from the past, this red line right here is what? That's where the Dow closed yesterday. That's always your benchmark from the previous day, okay, the previous business day when the market was open, okay? So, as you see, the Dow never got up as high as it was yesterday. Okay? It was down all day today, right here. And as I said on the radio program yesterday, and as I often said, whenever you have, please put this in your notes, whenever you have a holiday that falls either on a Friday, okay, and I'm talking about a federal holiday when the market's going to be closed. Once again, a federal holiday when the stock market, the U.S. market is going to be closed. When that holiday either falls on a Friday or a Monday, you are going to see this phenomenon occur. Because what's going to happen is that people, the savvy investors and traders, are going to pull their money out of the market. They're not going to let it sit there over the holiday and not make money. And they're going to move their money into safer vehicles like treasuries and U.S. bonds. So what do you see? You're going to see the Dow go down, and, my friends, you're going to see the dollar go up. See the dollar here against the Japanese yen. See the euro down against the dollar. See the change? See the Great Britain pound. What is it? Down against the dollar. Okay? So what you have happening here is that the dollar only retreated against the Japanese yen, and that's going to be recaptured on Monday because the Japanese market will be open. Okay? So notice this, and I'm going to show you a plethora of things right on this front page of Yahoo Finance where you will be able to see where it would have been very, very easy if you didn't already make your money in the last couple of days to just make money off of what you're seeing right here. Now, what else do we see on this page for those of you that are just starting out trading and investing? When you see a situation, okay, where we have the Dow down, and notice it was down over 100 points. See that right there? Down 100 points. When we see that, you immediately need to look and see what's happening with oil. That's your first checkpoint. Okay? This is where oil closed yesterday. There's your red line once again. See how simple this is, everybody? And look, it closed below and trended down all day long. It never got to the high that it reached yesterday. Okay? So, when we see the Dow down, we double check to see whether or not the downward trend has legs by going to oil first. We should see a matching pairing of oil being down per barrel, directly proportional to and in alignment with the Dow being down. So, in your notes, put this down. When the Dow is down, confirm the stability of and the ongoing trend of the Dow going down by looking to oil. You should see oil down as well. Very, very seldom do you see oil down quite a bit, okay? And when I say quite a bit, I mean trending like this, okay? And the Dow is way up in positive territory. You're not going to see that often. Okay? Now, strange things happen from time to time, but that is an abnormality when you see that. Okay? The next check that you do, immediately when you see the Dow down this much, you go and you check gold. All right? Once again, gold. This is where gold closed at yesterday. There's your red line. And look what gold did today. All right. It began to bounce, but it never did break where it was yesterday. That was sort of like a glass ceiling for today. So now, you as a beginner trader and investor, you have empirical evidence that's beyond a shadow of a doubt that the market is trending downward and will continue to close down on this, the long holiday, birthday holiday for Martin Luther King. So once again, Dow is down, triple digits, confirmed by oil. way below, double confirmed by gold. Okay? Very, very simple. Then you turn around and you see the other two indexes coming back in lockstep. The NASDAQ is in negative territory and closed out today, and so did the S&P. Now, what this is, family, is nothing more than the greed of Wall Street and their inability to trust one another. They're pulling their money out of the market because, A, they want to go ahead and have that money placed in, shall we say, more stable, although less yielding investments over the holiday, okay? And B, whatever liquidity that they pull out, they may go ahead and do an overseas play on Monday in the foreign markets. But the last place they want to let it stay at over this long holiday season or period, which, you know, would end on Monday, and the market opens up here again on Tuesday, is the last place they want to leave it is in the U.S. market. Okay? So knowing that, that's why I was saying yesterday on the air, if you're going to go ahead and sell to close any of your positions, you do it first thing in the morning. Because water table was going to be exaggerated, just like, and this is water table time, right in here. That's that 11:15 to 12:15 time. Look at that. See right here? It just keeps dipping down. Then, what do we say? Going into 12:30, 1-ish, if you're going to see a spike, that's when you're going to see the spike. Well, it happened a little bit earlier today, right there. Then it plummeted again. Okay? You combine Friday with the Monday holiday, long weekend, Friday fade being exaggerated, confirmed by the normal behavior patterns of the water table here. That lets you know that if you're going to sell, you need to sell early in the morning. If you hold a position into water table time, you need to go ahead and get out because of the exaggerated Friday fade, which was destined to come and did occur. Okay? So, what we see here is for instance, look at how quickly people started dumping way even after hours with regards to oil. See, this 6 p.m. here today. Still getting out. Liquidating their positions. Let's go ahead and look at gold. Okay? Right here, 6 p.m., people still getting out. They're way below yesterday's ending and closing. So, please, once again, as we get off of this, I want to say this to you. Look at your calendars, okay? And when you look at your calendars, I want you to pay close attention to any holiday that A, falls on a Friday or a Monday that comes at the end of a quarter. And I'm talking about a calendar quarter, because that sets the precedence for what we call the trifecta. Okay? Now, the trifecta effect is one in which we have a quarter that is ending, and there's a holiday that's associated with either that Friday or that following Monday. So now, if you'd be so kind, I'm going to give you a list of days that the stock market is going to be closed in the next month or so. And on these particular days, I want you to pay attention to whether or not that holiday falls on a Friday or that holiday falls on a Monday. Because the same phenomena, my good friends, that I just described to you right now, tonight, during this webinar, will occur again. And if you fail to make any type of substantial profits today because you didn't know these concepts, well, you'll be sure to make them the next time because you will review this webinar or review your notes. So, the next time this same phenomena, which has occurred with Martin Luther King's birthday today, falling on a Monday, okay, although he's actually born today, but the country recognizes it on a Monday, which calls just a long weekend, the same type of behavior patterns that you saw the market do with these sell-offs and the dollar do down here, you're going to experience it again on February the 16th. Write that down. Excuse me. It's going to occur on February the 12th. Write that down. It's a Friday. February the 12th. Why? Because the market is closed on February the 15th, which is President's Day. So once again, in your notes, you replicate the same strategy that I discussed just now and that I was talking about on the radio broadcast yesterday. Please refer back to our radio broadcast on demand at Wiz Radio if you'd like to cross-reference that. And you're going to be looking at the dollar rise on February the 12th, the Dow being down in an exaggerated form, and look for an exaggerated and very, very much of an exploitive type of sell-off that will occur by and through the Friday fade on the 12th. So, February the 12th, and it's going to run all the way through the 15th because the market would be closed. So then, what do you want to be doing? You want to be looking at possibly a UUP play way out in front, okay? What are the February call option expiration dates? They come when? The third Friday of every month. All option expiration dates, third Friday of every month. So, if you're looking at a calendar that has February on it, the first Friday is the 5th. The second Friday is the 12th. The third Friday is the 19th, so that means your call option contracts will expire on the 19th. So, if you know you're going to have the exact same situation as far as a federal holiday and its relationship to the market, it's going to occur again in February, and I've given you the dates and the timelines, then you need to see whether or not a UUP play bought, not now, you buy it on the downtick, okay, you wait until you see it. Now, okay, that's good, that leads to this. When would you buy UUP? Keep it in mind the strategy that we're going to be implementing for the weekend of February the 12th. When would you buy UUP, and it's currently January the 15th? What economic, or let me put it this way, what index, what market index, U.S. market index, would you look at, and when would you buy it to maximize your profit that may or may not occur before the weekend of February the 12th through the 15th? Well, you'd be looking at the Dow. And the next time between now and February that the Dow goes up over our 90-point index and everybody runs to do a UDN play, you then know that UUP will be what? Down, and down markedly. So you go in and you buy UUP with a February call option expiration date in anticipation of the February 12th through 15th weekend. Once again, staying out in front of the market, let the market come to us. Because as I said, you're going to see the same phenomenon occur again. Okay? So I wanted to start out today's webinar showing you how, based upon what is happening with, and things that you know are already written in stone, so to speak. I mean, these federal holidays are federal holidays, and the market is not open on federal holidays. There are ways that throughout every, month or a couple of months, when a federal holiday hits, you can plan a strategy that will optimize your profit potential during that time. And the market responds. If you go back and back test what I'm saying now, you'll see that the market responds in the same way as far as how many points establishing a downward trend. Certain ETFs that are tracking certain market indicators are up. Certain ones are down, depending upon how they are directly or inversely related to the market trend. And it's just that simple to make money. So many people, and I put this up on our homepage the other day as a Wiz journal entry. So many people try to cherry pick sectors or cherry pick ETFs that align themselves with certain sectors and try to get paid that way. Now, that might be one way to generate revenue and income out of your portfolio, but one of the best ways to do is to use what the market gives you. I call them the giveaways, such as the federal holidays. I know what the market has to do and will not do coming up to and coming out of federal holidays. I'm sharing that information with you tonight, and I've done it in the past. The next things, earnings reports. Earnings reports have to do with the psychology of the market. And as a result of us knowing the actual dates that earnings reports are going to be released, and as more and more of you beginning traders and investors learn the psychology of economics and the market, you will become an expert at being able to realize beforehand what the probability of a earnings report impact will be on the market based upon what the analysts say and the headlines say prior to the earnings report being released. Okay? The next thing that is a giveaway for you that you can always be able to bank on, okay, is the trifecta effect. When you look at your blended average, that is to say your revenue and income coming in over your portfolio over a year, you should see a marked rise in your profit doing a trifecta. Okay? Now, trifectas typically occur, okay, around our major holidays. And as a result of that, always remember this. The savvy investors, that's the hedge funds, the pension funds, and the like, they will never let their money stay idle over a long holiday that aligns itself with the end of a quarter. Why is that the case? It's very, very simple. Because they have to report their quarterly earnings reports. Okay? And so as they wind out end of a quarter, they want to try, if at all possible, and make as much money all the way to the end, if that means going ahead and selling off their positions, okay, so they can show that cash on their books for the last couple of days of the quarter, especially when it's aligned itself with a major holiday, then they do that. Okay? Because no matter what you say, when you look at a publicly traded company, cash is still king and will forever be king on their books. Now, a little bit later on, I'm going to give you an insider secret as to certain things, certain reports you can look at with the SEC that will tell you when a company is increasing its position, a hedge fund, is increasing its position in a company, and you'll be able to let the finest strategists and analysts on Wall Street get you paid. All you would do is be like a teacher that's grading test papers. You'll be able to go back, take a look at these two reports that I'm going to give you a little bit later on, and you'll be able to find out who's moving money where and when and how long they let the money stay there. That's huge for you to be able to not only obtain but maintain your economic liberation. For those of you who have been members of the Wealth Institute for a while, you know I always say, utilize the flea on the elephant concept. The flea gets all the benefits and advantages of the elephant without doing any of the work. All he has to do is just attach to the elephant, and wherever the elephant goes, and whatever benefits that the elephant receives, the flea does as well. We, my friends, are humble little fleas, but we're going to get all the benefits of those big Wall Street elephants. And that's why we're showing you this inside information stuff, stuff that they will always keep from the masses, because this kind of information, if you know exactly where to look, instead of looking at the whole picture. Imagine yourself standing in front of a beautiful mural painted by Picasso. Okay? And as a result of that, if you stand too close to it, okay, you can focus on, say, maybe a particular stroke of Picasso. Okay? But if you get and stand way back from the photograph, okay, you can get the whole grandeur, not photograph, painting. You can get the whole grandeur and the fullness of the painting itself. And what we're saying is we want you to step back from the market. So many people will try to just focus on one little thing in the market, and that might be the analytics. And they're just going to be the greatest analysts of all time. So they're going to do all of the various statistics. They want me to teach them about stochastics. They want me to teach them about RIMs. They want me to teach them about MACDs, etc. And they get frozen and get caught up in the analysis of paralysis. What I'm saying to all of you out there is to step back from the market. Look at the whole market. Look at the various indexes. Look how they interact with the U.S. dollar. What do you need to do? Do your DI analysis every day. What is that? The first D. Check and see how the dollar did. Okay? You want to check futures. Okay? As you go to your I, the second I. So the first D is for the dollar. The second one is for I, which is the international futures. When you get up in the morning, before you go ahead and decide that you're going to take a position or trade, you need to see how the foreign futures closed. If they closed up, then it's an excellent probability that our market, these indexes here, are going to open up. If they close down, it's an excellent probability that these indexes here are going to open down. The next thing you want to do is look for major headlines in the news domestically. That's your second D. Okay? Major headline news domestically, because they can drive, we're talking here, these major headline news, okay? They can drive prices. As you know, right now we have a position in Verizon. Well, look at here. This press release right here, we go take a look at it real quick. With our position in Verizon that we've taken a call option position that's going to expire in February, on February the 19th. As we run up to that time frame, we want to see things like this. Verizon is going to lower their price plans? Wow. Okay. Now, as a result of that, I want to know, when was this press release issued, because it's going to have an effect on Verizon price once it's absorbed by the marketplace. So what would you do? Well, now you're doing your D, your second D in the DI analysis, which means you're looking at domestic press releases and domestic situations that will affect prices of positions that you're in. And so what do we have here? This was released today, Friday, 7:30 at night. So now, what would you do? First thing, Tuesday morning when our market opens, see where Verizon opens at in relationship to where it closed at today. So let's go take a look. This is very, very simple, you guys. All right? We go and take a look here, and what do we see? Let me get this thing here coordinated. We go right up here. Write this down in your notes, everyone, because I want you to be able to back test this on Tuesday, okay, as a result of us discussing it tonight. So we go in, and I'm trying to get a look here at, oh, I'm sorry, doing the wrong one. We go in, we punch in Verizon. All I did was put in the symbol right there for you first-time beginners and traders, VZ. And so now I'm getting tactical with my portfolio. I always want to stay ahead of the market. I've just been given that information right there through that press release. I'm looking at what's happening with Verizon. I see yesterday, this, once again, red line, that's where Verizon closed at yesterday. And everybody, I also noticed, once again, that they closed today below where it closed yesterday. Never got up there. But then, look at this volume. Wow. Well, we expected that. Why? Because we got the long holiday weekend and the market. People are selling off, taking their money out of the market. They don't want it to stay there overnight, okay, over the long holiday. But then we noticed something interesting here. Right here, about 38 minutes before that press release occurred, what happened? It started to uptick. Okay? Now, let me say this to you and make this very, very clear. By the time the news hits the major media and gets released, like we just saw with Associated Press, rest assured that the insiders have already gotten it. Okay? The insiders have already gotten it. So what happens is that, see right here, where that press release came out at 7:32? Well, let's go back. Do not ever be disillusioned to think that this uptick, okay, that occurred right here about 30-something minutes before then is a coincidence. The insiders, the institutional investors, hedge funds, and pension funds, they get that news hot off the press. And that's when you saw this after-hours uptick. Okay? So that means we need to make sure that we monitor Verizon and the absorption of that press release, okay, on Tuesday morning, first thing. Because Verizon should continue to trend upward first thing Tuesday morning. So now for those of us that have our positions in our call options, February call options with regards to Verizon, we must make sure that we monitor that quickly, because in the event that we want to go ahead and pull out some cash, we need to go ahead and make that decision before the morning water table, which begins at 11:15 and, as we know, ends about 12:45. Okay? But before you decide to just pull out your money, once again, I want you to go back before you do that, and I want you to pay attention. Let's do this real quick. Let's go and look at Verizon, okay? And I'm gonna give you another little insider tip on how to play this on Tuesday morning if you decide to go ahead and take out some money. Okay? I'm looking at the February call option on Verizon, and as you see, if we were at the $33 mark, because Verizon at one time was kicking $32 and some change. Let me go back and confirm that for you, okay? Let's go back. Notice what I'm doing. I'm just back-clicking on summary. It'll pull up the Verizon for me. Look at the 52-week range, $26 to $34. I want to know when in the last, say, 3 months, Verizon had gotten up in the 30-plus range. And I'm doing this to give you some foundation, okay, as to how simple it is with just a few clicks of your mouse for you to get paid merely by observation. You know, we talk about that in class, monetizing observation. That's what we're doing right now. So let's take a look at this situation. We see back on December the 28th, Verizon was at $33.49. $33.49. Now look at this drop. Okay? So now do you think Verizon is going to continue to let that stock drop? That press release is not a coincidence. That was a very strategically placed press release. Now, let's find out how strategically placed that press release actually was. Verizon has what? An earnings announcement that's supposed to come out when? Bingo. January the 26th. And for those of you that have called the office and talked to me, and you said, Verizon is falling, should I dump it, should I dump it? I told you that Verizon, just like IBM has recently done, because their earnings report is coming up soon, they're going to do something. There's going to be a press release that's going to come out prior to their earnings report to drive that stock price up. What they're doing is giving the market a teaser, because they could not and would not continue to allow, my good friends, this to occur. So let me show you. They cannot let this right here occur. Hold 1 second. I'm sorry, the computer's moving a wee bit slow, but I'm trying to drive home the point to let you know this is so elementary. See, Verizon couldn't afford to let this continue to drop. Not running up on their earnings report, because even if the earnings report comes in below analyst expectations, if they come out and say that they're lowering their voice plan prices, as you just saw in the press release, okay, that stock price is going to do what? It's going to go up. See? So right here, Verizon lowers its voice plans. Strategically issued, now notice this, after the market closes on a long holiday weekend, so it can be completely absorbed by the market all day Saturday, Sunday, and Monday, so that stock can start an upward tick on Tuesday when the market opens, and as the days move closer and closer to their earnings report day on the 26th. And what happened? Bingo, right there. Started ticking up. Verizon's been down for days. Let's look at Verizon for the last 5 days. Going down. I'm going to show you right now on the chart. Look to the left-hand side right here. All we do is click on the 5-day chart, and we see all 5 days playing around here, and then boom. See? All of this is down. So now, what I'm trying to get you to tap into is that there's a rhyme or reason as to how the market moves. And when we have a dead giveaway earnings report play, we know when this company's earnings report is going to come up on the 26th. We see how the game is played with the teaser press release, where they put out the teaser that they're going to lower their particular voice plans. And immediately the market turns around and the stock starts upticking. They know how to play the consciousness of the average trader and investor, they being the major institutional investors and the hedge fund investors, pension fund investors, and the CEOs of these companies. They know how to put the carrot on the stick out there in front of the regular novice investor to get them to turn around and bite and run up their stock price. So once again, don't think that that press release just happened to occur. The master at doing this type of media manipulation to cause their stock price to go up is Apple. They did it last year in January with regards to Steve Jobs, okay? And for those of you that are in the Wealth Institute, you know what I'm talking about. And for those of you that have just recently joined or you haven't been with us, a year or more, you can go back and look at some of the classes and webinars that are in archives, and you'll see what I'm talking about with regards to Steve Jobs back in January of last year. And why is that? Well, let's see. Let's take a look, okay? Notice what I'm doing here with Apple. I want to show you something here, okay? Now, they're very, very clever at Apple. Now, I come down and I click on company events, all right? Click on company events to try to find out when the earnings reports are going to be released, etc. Well, what do we see up here? We see right here, Apple is releasing their earnings report on when, everybody? January the 25th. Now, look here, January the 5th, January the 4th, January the 28th. Look at them hitting 52-week highs. Now, what have all of you been hearing? I don't care if you're a tech nerd or whether or not you're a tech genius. What have you been hearing constantly since Christmas? You've been hearing about some people call it the Jesus tablet. Some people call it the iTablet. Everybody's been talking about that tablet that's coming out. Do you think that's going to be released by Apple? Do you think it's a coincidence that they've been flooding the market with, they recently had the high-tech super show, and Apple was all the rave out there because of that, okay, and the tablet that they're going to be releasing. All of that is just like Verizon releasing their statement today that they're going to reduce their voice plan price point to run up their stock price. Apple is doing the same thing, and they've got their pop already. They've already hit their 52-week highs, way in front of their earnings report. So, the thing that you have to understand, if you knew that their earnings report was coming out on January the 25th, then in December, you're hearing all of this plethora of information about this tablet, then it would behoove you to be prudent and buy your option here to get all the advantage of this run-up coming here. Now, yeah, Apple is going to continue to go up and down between now and then. But the bottom line is that the closer you get to the earnings report date, look at these numbers. Look at where this stock went from today. $205 to $211. It moved $6 in one day. Look at this huge volume right here. And it's not going to do anything but get more voluminous as we get closer and closer to the 26th, because more and more suckers are coming in now. This right here is just a typical fade. Those that made money on the run up here, see, they made their money right here in the morning. That's why I tell you, Wealth Institute members, if you're going to sell, you sell in the morning time. And so all these people were taking their money out for the holiday, out of the market. And there you have the trend. So very, very predictable. Very, very predictable. Confirmed by our volume. And substantiated and stamped with the seal of approval with this spread. $6 spread right there. Okay? And so the point I'm trying to make is look at your list of earnings reports. Look at what good product or service that the company is bringing to the table. Okay? Get out in front of the market. Always let the market come to you. Okay? If you can't dance, if you're not on the dance floor before the record starts, don't you get out there once everybody's dancing. Okay? You just stand, you should sit that one out. Okay? You get caught up in the midst of the fervor. All right? Don't do that. Don't do that. That's why we always stay out in the front. And by doing these things, paying attention to your whiz alerts that I'm sending to you, leaving emotion out of the situation, knowing where you're going to sell before you buy, okay, etc., covering your positions once you've reached your initial profit margin that you set, covering your positions if you have more than one contract and let the other contracts work for you, okay, as the run-up goes up, but being ready to pull the trigger immediately in the event that the market goes down. These are the ways that you make profits and lock them in and minimize your losses. So today I wanted to give you two household names that I think most of you could relate to, and that was Verizon and Apple. Okay? And I wanted to give you a case in point to see how the market is responding. Now notice, after hours, Verizon is still ticking, Apple is ticking back up. Almost at the end of 8 o'clock tonight, it was back up to 2006. Now, let's go back and see if there was anything in the headlines that has after market traders buying, the institutional traders buying, or was there something else that was pushing this? Oh, guess what it was? Who has the Apple contract for the wireless carriers. I talked about this in our last Wealth Institute class, everyone. You got it. These folks right here, AT&T, okay? And I indicated to you that they were bucking and going against Verizon. And sooner or later, there's going to be a standoff between the two. Now, AT&T has a contract now, but Verizon has clearly said, and we talked about this, please review our last class in our AskTheWiz Wealth Institute class and session, which was held on January the 2nd. It's on demand on our website right now. We spent quite a bit of time on this particular interaction between these two companies, and Verizon has indicated, AT&T, if you slip, we've already been talking to Apple, and we are going to try to come in and undercut you on the price point. Concurrently, Apple is sitting in the catbird seat saying, you guys fight it out. We just want the best quality service for the lowest price. What has that done? It's caused both of these companies, as you see right here, to what? Lower their voice plans, which is also going to drive down any other type of services that they're providing for Apple as well. And so this type of news is going to cause increases in people buying the Apple products, okay, iPhone, the iTablet, et cetera, and as a result of that, this information, they have indirectly caused Apple's price to do what? That's right, go up. See right here? Now, notice the time. 7:59. When was that press release released? 7 what? That press release came out at 7:30 or something. So the market immediately absorbed that. So you can expect Apple to do what? See that? See the time right there? 7:32. So you can expect Apple to do what during a Tuesday when it opens up at 9:30 in the morning? It should be trending upward. Okay? So there you have it. A case in point of how all of this shakes out. I think we have a question, and then I'm going to give you another case in point, whereas a natural disaster that has occurred, and we're talking about Haiti, is an opportunity for us to go ahead and generate revenue and income such that we could perhaps give to some of the relief efforts. Okay? Question?
Okay, you have several. Are put plays a good idea for triggering after ER when the air goes out of the balloon?
Let me answer that first. The answer to that is yes. But do this. Look at the amount of time that it is from the time that the earnings report was released to your contract expiration date. Don't let that contract expiration date be too close to you so that your put doesn't have time to go ahead and reach its full profit income potential for you. Okay? So make sure that there's enough time for the market to take whatever information, say it's a negative earnings report, you want to give the market time to digest that, okay, such that your put will then be a stronger position and generate you more money. If the contract expiration date is 1 to 2 days behind the earnings report, then that may not be enough time for you to get the full advantage of the sell-off, okay, with regards to the price of the stock, which then is going to drive the price of the put most times up. And you want to have as much time for the market to really absorb that bad news, okay, if it's a negative earnings report, to give your put the maximum opportunity to increase in value and generate larger profit for you. Okay, next question.
Okay, this is sort of a two-part for this one.
Okay.
You're asked, can you explain what a purge is, and is this a purge today?
Purge is a loose term that is used in the marketplace where you have a huge sell-off that occurs, and it's usually triggered by a major headline, such as Ben Bernanke standing up saying that the Fed's going to keep the Fed fund rate low for, quote-unquote, an extended period of time, the market would immediately go into a purge with regards to that. And money will flow one way or another depending upon the impact of that statement. And then what we saw today, what we saw overall across our indexes was, yes, a market purge. That's going to occur, okay, like clockwork, on your holidays that occur on a Friday or a Monday, or especially when you have a trifecta that's occurring, okay? So that's a market purge. Now, you can calculate those easily by looking at your calendar, okay? Index off your federal holidays, just that simple. So concurrently, you want to not necessarily be 100% convinced that you're going to do a hardcore dollar play, i.e. a UUP or some other type of, say you do an ETF that's indexed directly to the dollar. I'm not saying you do that hardcore play, but be leaning towards that because the market is going to run to the safety of U.S. Treasuries and take on the lesser yield, okay, because they want to make sure that they don't get caught up in the sell-off and lose any profit. So they sell off first. Now, what does that do? That sets the precedence for when the market opens after the holiday to go ahead and buy back in low. Because when the market does the purge, what happens? Many positions are sold off and the prices are down. So what you do is take your profits off the table. And then the first thing, when the market opens back up, okay, you have to make a decision. Do you buy while the stock is rising, or do you have confidence that there's going to be a slight sell-off during the water table time of that first day when the market comes back and you buy on the dip? Your major indicator with regards to that, everybody, should be what? Volume. 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 So, yes, today was indeed a purge, and you're going to see that coordinated with holidays, federal holidays, that is, that occur on long weekends. Next question.
Will Apple purge before ER?
Interesting. Apple will probably, and this is just my opinion, Apple will probably do the Walmart on us, okay? If you remember, family, we did extremely well on Walmart all the way up to 52.50, okay? And for some reason, and I'm talking about in August, we did over 500%. But then for some reason, Walmart would not break that 52.50. So it stayed right in between 50 and 52.50. And it just sort of hovered there. With the momentum that Apple has, and, oh, by the way, did you guys hear that they're talking about doing a pre-release of the Apple tablet before the end of the month? When just the beginning of this month, they say they weren't going to release it until March. I said it in our last Ask the Wiz Wealth Institute class and session. They came out this week and saying that they're going to release it before the end of January. When is their earnings report date? January the 26th. So see, once again, that's a teaser. They play with society. They play with the common investor. And they know the common investor hearing that is going to run to try to buy up the stock because they expect that the herd, H-E-R-D mentality, is going to drive the stock up even more so past these 52-week highs that they've recently experienced. So to answer your question, I do not think that there's going to be a purge with regards to the Apple stock. At worst, it will behave like Walmart and sort of just hover. But then at best, it might indeed actually go ahead up, and we may actually see another 52-week high right around the issuance or right after the issuance of their January the 26th earnings report. Next question.
Okay, Rodney, go right ahead.
Okay. Can you guys hear me?
Yes, I can, sir.
Okay, great.
Welcome.
Great. Okay, thank you. I had actually two quick questions. I don't know if you can answer them both or not. I got a little confused about reading volume. I see it's a a big number and things of that nature, but then I also saw a big number on that part when everybody's selling off too. So I'm getting a little confused on why you're looking at volume. So could you kind of explain that?
Okay, hold on, and then hold that, and then I'll answer your next question. Okay.
Okay.
And hold on. Let me answer that one. You see, Rodney, and the rest of the family that's listening, volume is an indicator of the activity as it relates to that particular stock. How many people and entities are buying and selling? How many shares are actually being sold in the open marketplace? Okay? Volatility is a good thing both ways, whether or not it's a good thing if you have a call position and people are buying, and it's a good thing if you have a put position and people are selling. So volume lets us know how much interest a particular position is getting during any particular session, trading session. Okay? Now, the next thing we want to do is look at the day's range. How is that volume affecting the day's range? That's right here, buddy. How is that volume affecting the price spread in the stock? As we see here, Apple broke its 3-day average, 3-month average of 18 million shares. That's about how much it trades on average for the last 3 months. It broke it today, and that's the average across 3 months per day that Apple normally trades. It broke it today by getting up to 21 million. Now, there are a lot of factors that contributed to that. The holiday, the earnings report coming up, the release by Verizon and AT&T about reducing their voice plans, et cetera, et cetera. But the thing is when you see this type of volume occurring, you know that, and in the pit, when I worked on Wall Street, we used to say, this particular stock is in play. It's in play. And the thing that what we like to do when, I was working on the institutional side, we come back and we check this at the end of the day. If after hours, when we put in all of our trades to clear, and it's, 7:30, 7:45 or whatever, we see when we leave the floor that this is on an uptick, we have an excellent probability in our minds, we think, that this stock is going to be up first thing Tuesday, because let's use this stock in the holiday. Monday's the market's closed. So because we know the average investors, when they come in, they're going to come in and they're going to try to start buying right here at 206. Mm-hmm. We've made our play in, down here 205-ish, probably 290-ish or whatever the case may be. And all of this sell-off right here, we set the precedence for the rest of the market, the non-savvy, to run this up. Now, during the morning fade, the morning water table, we'll have to sell this position right in here, 11:30s. And whatever spread all the suckers ran up the price on, based upon what they see here in after hours over the holiday, is all profit for us. You follow me?
I follow you.
Yeah. But see, all of that, once again, my friend, is predicated right in here. We look at that volume, and we're seeing, get a load of this. Here it is. We're on a holiday weekend. Everybody's doing what we expect them to do. They're selling off. Guess what? That's a good time to buy Apple. I'm an institutional investor. I'm sitting on a fund that's, say, maybe $3 billion fund, literally, and I've got $30 million I need to place for this long weekend. So I'm sitting here saying, well, now I can put, say, $10 million in U.S. Treasuries and ride it out. I'm going to get a much lesser yield. But I can look over here and I say, now look, Apple, they got the tablet coming out. They got earnings reports coming out on January 26th. Verizon and AT&T release a press release at 7:30 tonight, saying that they're going to lower their voice plans, and their other data carrying plans. Let's go in and buy. So they start buying. Between 7:30 and 8, that runs this up to 206. That's that after hours. See that up? You see that green arrow right there? Mm-hmm. You see? So now that's the Venus flytrap. Okay? Because what that, and that's the analogy I like to use, because see, this is setting the Venus flytrap for all the suckers come Tuesday morning. See, when they come out Tuesday morning and the market has fully absorbed that Verizon and AT&T press release, guess what's going to happen? It's going to run this up. Keep in mind, we're that many days closer to their earnings report that's going to be released on the 26th. So now the herd mentality is going to come in. I better buy now because this is going to go up. If I don't buy now, because once it gets to the 26th, when the earnings report is going to be even higher, and that's when they're going to make all the money for us.
Okay.
First thing Tuesday morning. Next question, and then
all right. I'm glad you brought that part up because I just started last week, and I took your class first last week. So I was there when you talked about the Verizon play. So
okay, great.
I watched the Verizon play like all week, but you know, of course, I guess it worked in my favor because I had to set up my account. It took some time before I had some money available. So I noticed that when it went from, I guess it was around 18 cents on Monday till
12?
Yesterday when I finally, I think it was 12 when I finally put in, and I got it at 7 cents.
Wow.
Which I thought was a good deal. Now, here's my question. Now, when the market comes back, just like you said, on Tuesday and it runs up, what would be the strategy? Would I stay in to near the earnings report, or wait till it runs up on Tuesday and see where it goes and then come out? Because wouldn't it mean that the earnings report going to really drive it up even higher than what it could be on Tuesday? Or am I not looking at that correctly?
Well, I'm impressed. I'm impressed with your analytical thought and the way you're running things down, because you're answering your question yourself, but then you're creating more doubt. So let's walk through that. If you've got more than one position, then what you want to do is already know in your mind what price point you want to sell your original position. Let's say, for instance, if you bought in at 7 cents and you want to have 100% profit, then you know in your mind you're selling at 14 cents plus. Right. Okay? If you only have one position, then that will be your one hit. If you have more than one position, my friend, then you would say, okay, at least I want to make 100% profit, which would be the 14 cents, times the 100 units option positions in my contract, times the total number of contracts. Then on the balance of your contract, say you have 5 contracts, you would liquidate one contract once it hit 14 cents, okay, and then the balance you would go ahead and put your sell the close orders at 3 to 5% below your 14 cent index, okay? So that means then that you would come in and you would index the balance of your contracts. Say you had 5 and you sold off 1. You would index them at 13.5 cents. So you can't do 0.5 cents. So you have them at 13 cents. So all I did was I came under that, and if you had a calculator, you take 14 cents minus 3%, and it gives you that number, 13.58 cents. Okay? Did that with me?
I'm with you.
Now, what does that mean? That means simply this, that if that stock price, Verizon's option price, drops to 13 cents, your profits are locked in because all of the other particular option contracts will sell. So you won't be one of those suckers that will let the market turn down on you, and then you lost all the profit that you made, except for the one that you sold at 14 cents. You follow me?
I follow you.
Mm-hmm. So now you wouldn't have to do all 4. You may do 2, okay, and then let the other 2 run. You know, it's completely up to you.
I see. Okay.
Yeah, exactly. And then, quite naturally, if it's in the middle of the trading day, just send me an email, and then I'll try to respond back with you. But that's how we don't let our profits retreat on us. It's very, very important. So many people, for instance, they sit there and they get mesmerized by the profit and profits. And let's say, for instance, that 7 cents runs up to 21 cents, and you see a definitive trend line. And you say this thing we've already got past water table for the midday, and this thing is still going up. I think it can do 25. Well, what happens when 21 turns down to 28? Turns down to 18 and moves down to 16. But in your mind, you say, well, I just paid 7. I'm still in the good. Yeah, but you're losing money.
Mm-hmm.
You see? So that's when but if you know in your mind beforehand, if you take your heart out of it and you use nothing but the God-given genius in you, you use the third eye, okay, that's embedded in the cognitive component, of yourself, your brain, you would know, no, I'm getting out and I'm locking in these profits. You see? And that's why I always try to tell our Wealth Institute members, don't get mesmerized by that cobra that moves from side to side. Because sooner or later, it's going to lurch at you. And sometimes it don't have to actually sink its fangs in you. A cobra can spit the venom from afar and hit you. Either way, it'll take you down. That's how the market does. You sit there and get moving side to side looking at your profits, and next thing you know, that thing turns on you. You know, so once again, know where you're going to sell before you buy. And like my grandmother used to say, peace and blessing be upon her, that's tantamount to knowing that there's more than one exit in a house. Don't you go in a house that has only one door, because if somebody controls that one door behind you and lock it, you can't get out. Mm-hmm. That's the same thing when you're buying a position. If you're going into a position and you just buy and you don't know how to get out, and you haven't set your price to get out, the door's going to lock behind you, and the whole situation may come crumbling down around you, and you lose everything. Okay?
That makes sense. That makes sense. Appreciate that.
Okay. All right. No problem at all. Thank you for your questions. And as you know, that there's thousands of other people on this webinar right now listening, and you've helped them with your questions as well, and we certainly appreciate you. You're helping the family learn.
Thank
you. Okay. Peace and blessings. One more. I got to go to Wisconsin. Okay. Okay. I'm going to take one more question, and I'm going to answer them all. I just got some more information I want to give you guys before we stop the webinar. But thank you for your patience. I'm going to answer all of your questions. Okay. Next question, real quick.
Okay. If the option strike price starts to fall and doesn't look like it will recover before the expiration date, is it a good idea to do a put play on that option to offset your losses?
Excellent. Yes, yes, indeed. That's you're running something close to, and I'm going to teach you guys about this. We're really going to drill down on this in subsequent webinars. You're doing a quasi, what we call straddle play. A straddle play. STRADDLE. And for those of you that want to get ahead of the class and sort of go do some homework and some research on straddles, you want to go ahead and just Google that. And there's tons of information on the internet which will tell you about various straddle strategies. But yes, that's what you would do, because now let me say what you would index off of going back and getting that put play. So let's paint a hypothetical, family. We got a position. And this position, expiration date on the option, we got to call option first of all. And that expiration date is going to occur Tuesday. And we're sitting inside of that, well, Tuesday's a holiday. So let's say it's going to occur Wednesday, because Monday's a holiday, so Tuesday would be the first day the market's open. So let's say the expiration date occurs on Wednesday, which couldn't happen because expiration dates occur on the third Friday of every month, but just bear with me. We're creating something here hypothetically. So now let's say here it is, Friday. And let's say we bought the option, say, for 50 cents, and the darn option is down to 12 cents. Okay? And we go and look on the put side, and we see that our in-the-money position has a definite large open interest component, which means that there are several persons and entities out there that are contemplating taking positions in this put. To offset your loss from the 50-cent initial call position, it may behoove you, just do the math now, make sure you calculate what your commission is going to be, because you got to pay your commission to your broker. But do the math to determine whether or not at the end of the day, after you include your commission, because you got to either do the sell to close on your call side and your buy to open on your put side and a sell to close on the put side, okay, to go ahead and make sure you get your profits. After you run the numbers, if you've minimized and come up with a number that's higher than the number that you would realize if you let your call option expire worthless, then yes, you need to do the straddle position. If, however, after the commissions, total commissions incurred by you on your account as a result of you doing a buy the open put and then a sell the close put, that's commissions 2 times, and your original commission that you paid on your buy to open on your call, if after you run all those numbers and you look at the possible upside profit that you're going to make from your put position, if the put position number, the calculation, is higher than your call option expiration contract number, then do this quasi-straddle position. If at the end of the day it's going to be less, then just let the contract expire worthless on the call option side, and then you just don't make that mistake again. Okay? But once again, the numbers will go ahead and blazon the trail for you when you're thinking about doing a straddle position. Okay? But also remember your timeline now. Don't let the call option position expiration date run up on you. And let me say this to you. That opens up this too. Typically, everybody, when you are 1 week out from your call option expiration date, it's crunch time. It's drill down time. You need to be ready to make some hard decisions. You want to be looking at your volume. You want to look at your trend lines with regards to the underlying stock on that option, and you want to make sure that you stay abreast of the headlines as well, because, like I said today, with Verizon, we've just studied that. That pops that stock instantly, okay? So what you want to do is this. The Monday before the Friday on your expiration date. Please write this down, everybody, okay? This is a basic rule of thumb. We used to use this in the puts, and we used to use this with our option contracts all the time. That Monday before the Friday, the third Friday of the month, when our contract expiration dates are about to hit, we are looking at volume. I'm trying to see how much interest it is in this option and how the option is correlating with the value of the underlying stock. If that stock is upticking on the Monday before the third Friday in the month, and my contract strike price, my stock strike price or my option strike price has not been hit, I'm evaluating the volume on the uptick towards my strike price. On my option side, on the price of my option contract, on the Monday before the third Friday of the month, I'm looking at how much open interest I have and how far away I am from the profit margin that I've already indexed. Once again, I know where I'm going to sell before I buy. And I'm looking at what does it look like with regards to the market continue to come to me to reach my profit potentials. That's Monday. Wednesday is what I call, and you in the Wealth Institute have heard me say this, that's the swing day. That's the day for do or die. I'm either going to sell my position at that particular time, because Friday is contract expiration date, or I'm going to do a straddle like the young lady suggested. Is that appropriate? Or I'm going to look at, would it behoove me, okay, to go ahead and just let that contract expire on its own, okay, worthless, because it's cost prohibitive. It's going to cost me too much to go back and try to cover myself with my put position and do a quasi-straddle. Okay? Okay. All right? Let me, go ahead.
Okay, this is the last question from Mr. Stanley.
Okay.
He says, for Verizon, if you bought at 40 cents, do you buy more at 5 cents on Tuesday?
Okay. The question then becomes, believe it or not, that may not be necessary. And let me tell you why. If you buy it at 5 and it moves to 15 and you make a dime, okay, that's a dime profit times however many contracts you buy and times 100, etc. You know the formula. But concurrently, if it runs up and you're at 40, okay, and you try to, and it goes up to 50 or 55, you made the same dime as well, but you got to go back and calculate your commissions on your 40. So which means that if you buy it at a nickel, say for instance, then we have to go ahead and calculate and back out all your numbers, including your commission costs, to find out what it has to actually hit before you really net out, say for instance, a dime in profit. So if I go back in and say my trade, you use Zecco and say it costs $4.95 or whatever, back that out and then come back in and run the numbers. But keep in mind now, to make the spread that you want to make, you would have to buy much more contracts, but it all washes out because it's a lot cheaper anyway because you're buying it at a nickel. So my answer to your question is, let the numbers tell you on your net after you backed out all your commission expenses and et cetera. So to answer your question, volume would tell you whether or not you want to come in, and it also will tell you at what price point and how much you want to come in at. Okay? And I'll be glad to help you with that calculation, okay, in the future. Okay, now, there's a couple of things I want to go over with you, these things have to do with the ongoing strategy play as it relates to the DIDI and what we did with Haiti, okay? Now, let me explain to you what has developed with regards to Haiti and the situation. And the things that we need to look at with regards to the international and the news headlines, okay? Now, when we heard about the hurricane, I want you to think back also, when I say hurricane, I'm talking about Katrina. Way back when there was Hurricane Katrina, what companies instantly benefited from Hurricane Katrina? You guessed it. Home Depot. And so what I'm doing right now is pulling up Home Depot for you to take a look at, okay? Because it's very, very important that you understand exactly how that whole situation can turn around no matter where information is occurring. And no matter what's going on globally, it can generate revenue and profit for you. Not saying that you're taking advantage of a catastrophe, because peace and blessing be upon the people in Haiti. Okay? In fact, it was stated that that may be the worst catastrophe in history. But I want you to take a look at Home Depot and its stock. What has happened 3 to 4 people is very, very interesting. You see that Home Depot has been consistently trending upward because of the inflation and what has occurred in Haiti. And this is not going to stop. So the point I'm trying to make is, what I want you to do is monitor Home Depot on the after-hours trading. Keep in mind we have the long holiday, correct? Okay. And monitor the trend line going upward with regards to Home Depot on Tuesday. And the things that you want to look out for is stabilization and the around Wednesday after Thursday. This one necessarily a play on Home Depot. But what you do want to be able to do is look those out. Okay? Some plays moving forward, February the 19th expiration date, Home Depot, HD. Now, you might say, well, what about their competitive lows, et cetera? Well, yeah, but it tends to be less in regards to lows as it relates to home improvements and things of that nature when you go head up with Home Depot. But this ties back into our DI analysis. Okay? Because you do your DI, during that the whole timeline there. Okay, as it relates to the natural catastrophe, you got to be thinking like that as well. Don't look at the news like everybody else looks at the news. Okay, because everything that happens on this planet has a direct economic effect on the markets. Okay, bottom line. So as a result of that, you've got to think like that when you hear about certain situations. That's why yesterday I was going over some of the target spots on the planet, like Russia, natural gas, and how it affects Europe. Okay? Like Kashmir, water, how it affects Pakistan. Okay? How the Strait of Malacca, how it affects, okay, certain areas of the Orient, and etc. So you got to think that way also when you're looking at what's happening on the news. You should be excited every night to watch the world news when it comes on at 7 o'clock after your local 6 o'clock news, because that ties into the international portion of your DIDI analysis. You should be excited about the 6 o'clock news, okay, which is your local news, because it would tie into your regional stock, publicly traded companies. Okay? And all of these are profit-making opportunities, no matter whether or not companies that deal in events that are currently in the news, front and center, we can make money off of them whether or not we think the stock is going to go up or the stock is going to go down. Okay? So it's real, real important that you understand that and be able to track everything, even though sometimes, a lot of us just look at the news and in a haphazard manner. There's profit-making opportunities in every single event that happens, in the world, okay? Okay? Now, once again, DIDI, that stands for our dollar indexes, both domestically and internationally. So DIDI. So once again, the dollar, the indexes, which means the Dow, the NASDAQ, the S&P. Go to your Triad investment portfolio on the website and pull down the Triad investment portfolio, and the first several symbols you see are for international market indexes. I put them up there on purpose so you can track those every day and see how they're doing. Your Hang Seng index, your Shanghai index, and the others up there. Okay? Then also, once again, let's go back down. When I say domestic on the DIDI, we're talking about your domestic headlines. Verizon and AT&T going to lower their voice plans. Okay? Apple Computer about to release their Apple tablet early. See, those are domestic headlines that drive the market here. More specifically, they're driving Apple. They're driving Apple after hours on Verizon. Okay? Home Depot. And now, let's go out to the last I in the DIDI analysis is international. International headlines. Excuse me. Like the terrible tragedy, the earthquake in Haiti. So every day you got to analyze those and then look at how they could, those particular factors across the DIDI could possibly be plugged into your investment portfolio. And that's important for you to always stay in front of the market and have the market coming to you, okay, such that you will be able to go ahead and generate revenue and profit no matter which way the market is moving. Okay? Now, next thing that I want to go over with you guys is, a lot of us work during the day. A lot of times the market's moving in the middle of the day. And even if you've got the fanciest and the most up-to-date gadget to try to track the market and make your moves, and even if I'm sending you whiz alerts and things of that nature, sometimes, pray tell, it's still difficult to do. Okay? So is there a way for you to say no 2 and 3 weeks in advance what the institutional investors are doing, okay? Or maybe even a month in advance. What if there was a way for you to know how they've made and taken their positions so that you would be able to be the flea on their huge elephant's back? What if there was a way to do that? Well, there is indeed a way, okay? Now, I'm moving you out now into a realm of more growth, intermediate to growth income strategies for your portfolio, which is very, very important, because what we've been able to do as a result of the market moving a certain way, we've been able to make money and generate high double-digit and triple-digit profits by having these rapid-fire hits, either doing them through option plays, headline manipulation plays, okay, or by being able to offset situations by really, really being able to analyze and utilize the DI-DI strategy, okay? That's why, and let me get back to the DI-DI strategy. That's why you see every morning when the market opens, if you were to go to Wall Street and work, the real top-notch traders and investors, they come in with 6 and 7 newspapers, international newspapers, early in the morning. And they've already read those newspapers and drilled down on those newspapers and everything else, and they know what is happening both locally and domestically. And now with electronic media, they really are up on them way in advance, so they know how to go ahead and take their positions as soon as the market opens to supplement their after-hour trades also. And so what I'm saying to you is that now you should have a firm foundation how to make money either intraday and at least once a month before the third Friday of every month. Not quite naturally, we do this constantly all during the week, but I'm just saying worst case scenario, okay, by every third Friday of every month, you should be in a position to have a check or some type of windfall, financial windfall coming into your account, okay? There's no excuse why you shouldn't. With over 2,000 publicly traded companies here in the United States alone, not to mention all the other foreign markets that we've given you access through ETFs and et cetera, there is no excuse for you not to be able to do just that. So now let's move out to a wider realm. Let's go on out a little bit here, and let's get into how do we calculate and keep up with those savvy institutional investors, because they are the ones at the end of the day, like during our last class webinar here, when you listen to the Wall Street expose, it is the institutional investors and traders that truly, truly run the market. So now let's go ahead and take a look at how that actually works, okay? Once again, I want to show you, before we do that, here on Walmart, you see this big pop here? Huge. Okay, huge. And then I want to do something real quick here, family. The hurricane occurred, right now I think they're going into, what, the 4th day since the hurricane occurred as far as hours are concerned. Okay. Let's take a look at how Home Depot has done in the last 4 to 5 days. Notice what I'm doing here? I clicked on 5 days right here. Okay. And the computer is moving slow. But I just want to show you how the DI-DI analysis works for you. Let's see here. Okay, looks like we're going to get a breakthrough here. Okay. All right. Now, notice, Monday, Home Depot is trending down. Okay? And if I'm not incorrect, that hurricane hit on Tuesday. All right? And then notice what has happened from Wednesday on. It's Home Depot, you guys. Constantly going up. Okay? And so what I'm saying to you is, even with, let's go back and look. even with the weekend tied to a holiday, et cetera, okay, and we know the phenomena, the purge, the sell-off, Home Depot in the middle of the day was spiking and still closed above where it closed the previous day. You guys take a look at this, track it, and be ready to go ahead and take a position in this if this particular type of trend line continues. Okay, now I want you to look at this document that I put together for you. It will be in the reference document session for you. And I just entitled just a little brief thing that I wrote up that's called Using Wall Street's Finest to Get You Paid. Once again, using Wall Street's finest to get you paid. Now, what I say in here is that there are some of the brightest minds, bar none, family, that work in the financial sector's market. Okay? They are just geniuses. And although they have gone and got the MBAs and their PhDs in econ and et cetera, in finance in some instances, they're also lay psychologists. That's right. They're layman psychologists, too. And the reason I say that is because they're masters at manipulating how you think. Okay? They're so masterful that they are able to get the vast majority of the U.S. citizens to go out in the middle of a recession with unemployment over 10%, with foreclosures at the highest rate since the 1929 stock market crash. They got persons to think that it was okay to go out and put money on their credit cards to buy gifts during the holiday season because that was tradition. If that's not psychological manipulation, I don't know what is, because it doesn't make any sense. How you going to go spend dollars and cents when you ain't got no cents? C-E-N-T-S. If you don't have a job, you don't have no money. But people still went out. Get a load of this now. Get a load of this. Tiffany's. Tiffany's don't sell a damn thing nobody needs. Tiffany specializes in selling what people want. Tiffany sells diamonds, okay, gold-encrusted brooches, and etc. Tiffany's reported that their holiday sales were up 17%. I rest my case. All right? Now, if Walmart was to report their sales up 17%, that makes sense, because they sell what folks need. They sell everything from car tires to food. But when you hear that Tiffany reports their sales up 17%, that adds credence to what I'm saying. Wall Street is the master location for manipulators. And so, you can't take it away from them. They're brilliant. So now let's read about what you could do to be a flea on the back of that brilliant elephant on Wall Street. As I say here, some brilliant people work in the investment management business, and using them as a research department just makes sense to me. Now, what I'm going to do right in there, right there, is also I'm going to say that kind of sense and this kind of sense too. All right, that kind of sense too, because you know those kind of sense add up to make dollars. All right, okay, here we go. Now, the key to using noted investors as a de facto research department, that's right, is that it is just a starting point for stock ideas. What I do is I look at what they're doing. Now, that don't necessarily mean I'm going to do what they're going to do. But it's a good starting point, because ultimately I want them to come to me. Keep in mind, that's Wall Street. We invest in front of Wall Street. So I want them to come to me, but I have to do my recon, my intel beforehand. And the way to do that is I've got to do just like I would do if I was at war. I'm going to send out my scouts, and I'm going to put them on a high point to look down at my enemy to see how they're moving their forces. Which way are the forces moving? What are their weak spots? How much are they putting? how many of their forces, in this particular instance would be dollars, how many dollars are they putting in a particular company? How long are they putting it there? What kind of position are they taking? Are they taking options or are they doing straight up buys? Are they buying futures if I'm looking at commodities? And how deep of a position are they taking? How long are they in the position? How short are they in the position? Okay? So once again, right here, what I do is I utilize them as a starting point for stock ideals for me. Now, I clearly understand, and you too need to understand, that you have to do the work and make sure it fits my criteria and comfort level. Notice, I say my criteria and comfort level. Nobody tells me what profits or percentages I want to get because nobody knows my financial situation and my economic obligations to my family and to those who depend upon me. Only I can make that determination. Okay? So I set that criteria. I don't try to wear somebody else's shoes. If the shoe doesn't fit me, I have to go ahead and find a shoe that does fit me. Okay? Now, I go on to say, in many cases, particularly with the value-oriented hedge funds, once again, the big boys, pension funds and hedge funds, you hear me say that all the time, they are the ones that drive the market. Okay? A stock may be part of an arbitrage strategy and may not be worth coming on or owning on a standalone basis. Now, that's the type of situation. Let me give you an arbitrage position that a hedge fund would take. Give you an example. Get a load of this. A hedge fund will go out and buy a large block of automobile automobile insurance companies. Follow me closely on this, family. They'll go out and buy a large block of Geico or a large block of Progressive Insurance, two of the largest automobile insurance companies. Now, I'm using automobile insurance on purpose. Then they'll go right out, okay, as an arbitrage type of hedge and go out and buy stocks in some of the largest companies that make brake pads. Whoa. Well, you say, well, Dr. how's that arbitrage? I'll tell you how. Okay? Because if the value of the brake pads company stock goes down, as long as they don't have a major catastrophe like Firestone Tires had years ago when they had that class action suit where the tires were rotted and some people got killed, and then all of a sudden Firestone had to pay a multi-billion-dollar payout and the stock fell, as long as that doesn't happen, the insurance company, the automobile insurance company position that the hedge fund takes has an excellent chance of accident claims caused by brake failure to be reduced. So now I just arbitraged or hedged against the downside of an increase in insurance claims against my position in Geico or Progressive as a result of the brake failure situation. Concurrently, every automobile on the road has to have brakes. But they don't necessarily have to have Geico insurance. Now, they got to have insurance, but they don't necessarily have to have Geico. They can have Progressive. They can have Allstate. They can have State Farm. But I take my arbitrage position by investing in the largest brake manufacturer that has the largest contract with all of the automobiles. See what I did? I offset the possibility of a dilution of my profits in my insurance position by taking a position in the lion's share company in brakes, okay, in the automobile industry. So that's how they do that game, and that's why I say right here that I have to look at each one of those positions to make sure that the strategy is worth owning as a standalone in and of itself. Okay? Now, another key that I use is to match my philosophy or your philosophy and time frame to the portfolios you are reviewing. So that goes back to what I was saying before. My short-term positions, okay, my rapid-fire money, my option plays, my earning report plays, my federal holiday plays. See, those. See, I can look at a calendar and tell you when I'm going to get paid on those. You too will get to that point. You'll be able to look. Two of your most trusted instruments of creating wealth are going to be a calendar and a calculator. A calendar so you know when you're going to get paid, and a calculator to add it up and calculate it. It's just that simple. And we're going to show you how to do that on a consistent basis here in the Wealth Institute. This ain't rocket science. It's super simple. So now, the next thing you want to look at is the following. Please, as soon as we put this up in the reference document section, print it out, put it in your notebooks. This is inside information. Nobody else is going to tell you this, but this is how on the floor we keep up with them hedge funds, and we are able to track where the money's moving, and we used to invest accordingly. Every quarter, notice I didn't say some quarters. Every quarter, it don't get any easier than this, family. Every quarter, as we enter into the final days of the windows for managers and investors to file their what? Write that down. 13 HF reports. Once again, write it down. 13 H as in hat, F reports of current holdings. My desk in my office, okay, looks like a small mountain of paperwork because I dig through the filings and I compare them with those of the previous quarter. Now, I'm about to tell you what the 13 HF report is in just a minute, okay? But what I'm doing is I'm back testing what those low-down scams did the previous quarter, because they have to, per SEC guidelines, report their positions and the value and the percentage of their positions in their holdings. Okay. Now, I also track the 13D and the 13G filings. Okay, which indicate what? Right here, a position of 5% or larger in a stock throughout the quarter. That's how they move the market. That's why I let you listen to, during our last webinar, Wall Street, where Gordon Gekko, okay, and the other gentlemen were going back and forth, okay, Sir Larry Lawrence, and they were talking about the percentage of stock they own in the company. Now, when Gekko gave that speech about greed is good, you remember when he stood up and he started his speech? He said, well, thank you for letting me speak since I'm the largest senior shareholder of this company. And he said, cumulatively, everybody sitting up there, all those vice presidents, own less than 3% of the stock of the company. See, that's pivotal. Because right here, these filings right here indicate a position of 5% or larger in a stock throughout the quarter, which means when those big hedge funds and those big pension funds, follow me closely now, when they take a position of 5% or more in a company, they are serious at that point. And they're going to make sure that that stock price maintains a certain level or they're going to sell. Now, as the flea on the back of that Wall Street elephant, I'm looking too. Because if I want to take a long-term position in, say, a company, say it's Martha Stewart's Omni Media, or whatever the case may be, because she just signed a contract with Home Depot. We talked about that 2 months ago. And before that, she signed a contract with Kmart. While she was in jail, she came back out and was still kicking behind and signed off. Okay, if I see a major hedge fund, because I looked at these filings, take a 5% position or more in a Martha Stewart Omni Media, okay, that tells me that they know something, that they knew about the deal that was going to go down with Home Depot when they were just talking about Kmart, okay? And as a result of that, I get in, but I'm willing to ride that for a quarter, 3 months. Notice what I'm doing. I'm getting paid every third Friday of every month. I'm doing intra-DI plays during the weeks. I even do intraday plays to keep money coming in. And now I'm going back and I'm pulling 13 HFs and 13 Ds and 13 Gs so that I can keep up with the quarterly activity of the the hedge funds and pension funds, so I can get paid once a quarter as well. Now, also, what else pays me once a quarter? My dividends. Okay? And if you go back and listen to our past radio program, I think I did compounding dividend-paying companies around Thanksgiving or in December. Go back and listen to the old radio programs. I listed about 4 to 5 of them, major dividend-paying companies that are compounding their dividends. So now what we have here is a way, if you look at the triangle that we went over in our last class and session in the Wealth Institute, now you got a way to have that middle tier of your triangle, okay, which is generating revenue income for you, to be consistently coming in, backed not by just your knowledge, but by the greatest minds on Wall Street. You're using Wall Street's finest to get you paid. Now, it doesn't take a lot of time, depending upon what company you want to look at. Like I said, okay, it takes an hour or so a week for me to search the 13D filings. Where do you go get them at? Right here, the Securities and Exchange Commission website. All you got to do is go there. You can look at the 13D filings, okay? And once you go there, like I said, I go to the website to see if any of my favorite value or any of those big-time investors have opened up or increased their position. I'm talking about people like George Soros. Just talked to you about him on Tuesday of this past week. Made $1 billion off of one trade shorting the British pound. Incredible. You can do the same thing. Soros knows how to look at things like this. And ignorance is big business. That's why they don't want us to know where to go. So what I'm saying to you is, don't just get fixated on one thing, like that Picasso portrait I was telling you about earlier. Don't get too close and get so technically. You step back, look at the whole canvas, okay? And once you know exactly where to look, what to look for, and how to analyze it, it's over with. Game, set, match. Continuously, you can get the profits that we're generating, okay? So, once again, you want to look at the 13HF. You want to look at the 13D, 13G. You want to go to the Securities and Exchange Commission website. Notice all this free. Don't cost you no $3,000 and $4,000 for no software, okay? And once you go to the website, you can see how the other people are investing, the hedge funds or whatever, because it's mandated. They got to go ahead and report it to the SEC. Now, once I've located an idea, then I can do my own research. I don't need nobody to do my homework. I can do it myself, because I'm going to pass the test myself. I'm going to make my own money, okay? So once I locate my own idea, okay, I do my own homework, and then I make an investment decision based on what criteria? My criteria, okay? If your baby needs a new pair of shoes, then you need to be focusing on that. And forget about getting them rims for your car. The baby's shoes come first. So you need to be investing to get the baby's new pair of shoes first. Get what you need first and pay it off. Okay? That's another thing. We are strong advocates of not financing anything. Okay? Now, some debate whether or not you need to finance a house for, tax reasons or whatever. That's another thing. But if we're going out here and we financing cars, something that depreciates in value the day you get it, no, that don't make sense. If you've got to just finance something, make enough money through your investments, okay, and your trades, and then set up a separate company, loan the money from your profits from your investment in the trade to that company, and let that company that you own finance your car for you. If you just got to finance something, all right, at least you be paying interest back to yourself. But bottom line is, we got to get out of this debt, okay? Can't be paying credit cards, double-digit interest, and et cetera, and think you're going to get out here and be able to whip this capitalistic beast. No, wealthy people, okay, they don't get in situations where they're paying usury rates with regards to a debt and whatnot. Debt is for people that can't afford something. That's why they get in debt. All right? Now, Once again, I close out by saying, having the sharpest minds of Wall Street work for me, uncovering potential valuable stocks is just one of the tools for finding deep value stocks with profit potential, and that's what I'm all about, profit and income. Because we don't want to be rich. We're talking about being wealthy, and we're talking about passing on generational wealth to future generations. Okay? We'll have this document up in our reference section for today's webinar, or you can go back and take down the information, and then go to the SEC's website so that you can go ahead and get that information at your leisure. Okay? And that type of information you would never have found in the public domain, but this information and all the other information that you've received in the past and that you will continue to receive inside the Wealth Institute is designed specifically for you to be able to come from up under the veil of ignorance that the system puts out there, because, like I said, ignorance is huge business, and we no longer going to fall under that particular veil. All right, any questions? What else? And we're wrapping up. Oh, boy, it's 9:51. We really appreciate everybody's patience, and we really appreciate you participating.
Okay, you have one question, and it was actually in regards to what Rodney Hill commented about earlier. You're asked, that he said that the stop limit order, that has to be a stop, that Rodney's concept had to be a stop limit order at 13, or his entire number of contracts will sell immediately, correct?
No. He could either, say for instance, in that example, we said Brother Rodney had 5 contracts. The stock price, the option price hit 14. He bought at 7. He had his 100% profit. He sold 1 sell to close at 14. Now he has 4 others. Okay, so now he came back in, and he put in, he could do it in any combination of form. He could put up the, all 4 with a sell to close position that would be at 3 to 5% below his current his first sell to close position of 14 cents, which means that all 4, he could do all 4 of the subsequent contracts at 13 cents. Okay, it really comes out to 13.58 cents, but you can't do 13.58 cents. So he would come back in with a sell to close at 13 cents, and if he did all 4, as soon as that option dropped to 13 cents, it would sell all 4. Or he can come back and do just 2 at 13 cents, and so that when that stock price fell to 13 cents, 2 would sell and the other 2 would stay. They'd still be active. Or he could do 1 at 13 cents and let the other 3 continue to run. So any combination, okay? But what I was trying to impress upon all of you is that if he wanted to lock in his profits, okay, depending upon how far away he was from his contract expiration date, he then would go ahead and either put all other 4 on that sell to close at 3%, or he would do a ladder type of situation where he would go in and maybe have 1 that would sell at 13 cents, and the other 2 he would just not even have a sell to close order, just let them ride, which means they may go down or they may go up. Okay? But let's talk about one other thing here. What if they go up? What if after he sold the first one at 14 and doubled his money, he has 4 others, and he puts the 3% sell to close in for, say he did all 4 at 3%, which means that that particular stock then would be indexed at 13 cents. That option would be indexed at 13 cents for a sell to close. But let's say they run up to 20 cents. And Rodney is grinning from ear to ear. Okay? So now he's looking at the 14-cent position going up to 20 cents. Okay? Well, then, based upon where his comfort level is, he would come back in, okay, and issue the sell to close on 1 or all of the 4 at 3% below 20 cents. And that means his sell to close positions now would move up to 19 cents. Those of you got a calculator, do the math. Just simply take 0.20 minus 3%. He got 19 cents. See that? So now, if the market moves against him, he won't lose. The lowest that his options could fall before they would sell would be 19 cents. So now he bought at 7, and he's guaranteed, per market conditions, to at least keep 19 cents of his profit. On that first contract, he bought at 7, and he locked it in and sold at 14. So he doubled his money at 100%. So if the options continue to go up after he made his first sell to close at 14, as they go up, you issue that sell to close right behind. Okay? Now, let me say this to you. Depending upon who your brokerage firm is, they're going to charge you every time you go in and issue your sell to close. So every time you go up, and then you come back up under it with the 3% sell to close, depending upon your brokerage account, they may charge you every time. Now, the way you can possibly get around that from time to time is simply do a modify. Some brokerage houses call them modify, some call them a change. Try to slip in and do a modify or a change order. Because if that original order hasn't been processed yet, then you'll be able to go ahead and do the modify or change without incurring another brokerage fee. Okay? So, tactfully inquire about that. Because as you see with this one, we move our stop loss through the sell to close from 13 cents to 19 cents. We just got us another 6 cents. And, buddy, let me tell you, that adds up. When you multiply that times 100 positions and an option contract times the number of contracts that you have, some of our Wealth Institute members are buying 40 and 75 contracts at a time. So you're talking about moving large amounts of money. And let me tell you, that adds up real quick. Okay? So the point I'm trying to make is that 6 cents difference between a position at 13 cents with a sell to close, now your option's gone up to 20 and you locking in at 19, buddy, that could be a couple of $1,000 based upon how many contracts you have. Okay? But once again, this is very, very simple, very elementary. And notice, then like my graduate students, I teach them quadratic equations. Notice, we're using a simple calculator, okay? And we're using 1 + 1 = 2. There's nothing difficult about this. But I need y'all to help me. I need you to go out and share this with somebody else. Sit them down and show them how simple this is, and show them how it is not difficult, but more specifically, get to the point where you can show them your account. Because that's what they're going to believe. When they can look and see where you took $30 and it became $300 in less than a week, or you took $500 and it became $2,000 in 3 or 4 days, okay, and there was no scam, and there wasn't no multi-marketing and all this and that, and that you walked them through how you did it, and they understand it, that's how you can go out and help somebody else not only obtain but maintain the liberation. Any more questions?
Okay, you have one last question here, I think, and it's saying, this is probably basic, which no question is basic, but so if I do sell to close at a lower price than the option is currently selling for, it won't sell till it gets to the lower price that I have to sell to close.
It depends upon what kind of option, what kind of sell to close you do. Do you do a sell to close limit? If you do a sell to close limit, it won't sell until it hits that price. If you do a sell to close market, it's going to close as soon as the order is executed. Okay? Now let me say something to you about this as well. Some brokerage firms would do what we call a slide sale. Slide, S-L-I-D-E sale. What that is this. Let's say, for instance, you do a sell to close on a position now that's at 50 cents. So you put in your order, sell to close at 50 cents, okay? And when you put it in, the option has already hit 40 cents, they'll do a slide sale on you and sell it at 40, which means it cuts you off at the legs. Because what if the stop price or the option price would have went back up to 50? Then you would have sold there, conceivably, and made a profit. Okay? So monitor the brokerage house activity, because a lot of times if the option has already fallen below your particular position, they'll sell it. Okay? And as a result of that, you've been cut off at the legs. Now, some of the larger, more reputable firms, they don't do that as often as others. You know, but that leads me to say this to you, family. Don't you ever think for a hot New York minute that the brokerage houses are your friends. They are not your friends, because they get paid whether or not you make money or not. They are the necessary evil. They are the necessary middleman that the market has put there on purpose. Okay, notice what I said. The market put them there, okay, to make sure that they hustle you and I to sell us products. So now, who do you think the allegiance lies between? Certainly not between us and the broker. Brokers are designed to keep you and I broke. That's why they call them brokers. Little humor there. But the point I'm trying to make is that their allegiance lies with Wall Street. Okay? And that's why they got direct access to the floor, and you and I don't. I got to call my old connections from 12 years ago to get my inside information, okay, to share with you. So all I'm saying to you is, and by the way, that ain't illegal now, okay? But what I'm trying to make, to share with you guys is that why is it that the brokers can have direct access to the floor, but those of us that are investing our money, the brokers take our money and invest it. Why can't we have direct access to the floor? The reason we can't is because the brokers work for them, and the broker's job is to keep us broke. Okay. Well, if there aren't any other questions, comments, or concerns, I want to say from the bottom of our hearts, we certainly appreciate all of y'all allowing us to be your community servants. We are just getting started. 2010 is going to be a great year for us. We're going to continue to do high double digits, and we're seeking to do high triple-digit profits. We've heard that we did mid-triple-digit profits, and when I get the actual report in, I'll be posting that so all you guys can look at it. We did mid-triple-digit profits in the middle of a session in 2009, and all praises be to the ancestors and the creators for allowing us to do that. If you have any questions whatsoever, send us an email at CS, that's community servant, at askthewiz.info, and I will try and endeavor to get back in contact with you. If it's in the middle of the trading day and you're in a position, okay, and you have to make a decision and you need me, call then. But don't call during the middle of the trading day when you're just thinking about doing something. That's what the emails are for. Go ahead and use that. That's what your message board is for. Go ahead and use that. And that's also what after-hours consultations with us with your teleconferences and whatnot are for, okay, where I can have time to just really focus on your situation and your individual goals and objectives for your investment portfolio, okay? Like always, we appreciate you allowing us to be your community servant and spend this time with you. Hopefully, you'll be able to listen to the radio broadcast in their entirety each Tuesday and Thursday from 2 to 4 p.m., and you can listen to them on demand if you don't listen to them live. Now, tomorrow, all of you that are on the webinar tonight, please log on at 12 noon tomorrow, because we're going to have another full-blown Ask the Wiz Wealth Institute class and session. And some of these concepts that I went over today, I'll be touching on a little bit, but we'll be drilling down on a complete separate set of data and utilizing other strategies and paradigms that are on the agenda item for tomorrow's class. Peace and blessings be upon each and every one of you, and God bless. All the best now. Good night.